Hello and welcome to Currency Point, presented by me, Evan Lucas, for FP Markets. As always, please have a very good read through of the disclaimer on screen. Everything in this video is general in nature, none of it should be relied upon as any form of personal advice. FP Markets does not know your personal scenario nor your personal financial goals, and therefore none of it should be relied upon as any form of advice at all. It is just general in nature only. Almost want the sort of the meme that comes around with that escalated quickly from Will Ferrell, because what is going on in inflation now is becoming more and more louder and louder of a real problem for how central banks around the world, not just in the US, which is what we're going to talk about, are having to deal with the post-COVID world. It is getting so incredibly strong. Levels that we basically haven't seen in 30 years on headline figures in the US. But then you dive deeper, and what is really interesting from an economics perspective is how much pressure is actually being felt by the general consumer. If you have a look at what's gone on in terms of how fast and strong the movements are in energy in the States, they've seen a 30% increase at the Bowser. It's about $3.25 a gallon that has moved in the US. They're now also seeing in the last 2 months things like poultry, fish, and meats increasing by about 14 to 15%. That is a real world feel for the US consumer. It'll really be a question for what that means for growth next year, if the consumption-led recovery that has absolutely boomed starts to really feel that pinch in price. And then you look across the whole board. I mean, 4.6% year on year is led by supply bottlenecks. There's no doubt about that. But that is 2.6%, 260 basis points above what the Fed wants. And that is a real problem in terms of where it sits, because it cannot continue to argue that this is not just a transitory problem. There are structural notices in there. There are structural signs in there. Yes, there's no doubt wages aren't growing at a level that they need them to be sustainable, but there is structural changes that are going on there. The price of those structural goods, construction, price wages increases that we've seen in the construction industry, the cost of medical equipment and medical, they won't come down. They're not going to change even when the bottlenecks come out. This is an actual move and a hold. And the market's asking that question. Well, the market's now asking three things clearly. Transitory, or is it structural with inflation? It's looking like there's parts of each and that the structural parts need to be addressed. You then have, does quantitative easing have to be addressed faster? Do they need to taper harder and stronger to get out of it faster, to slow down the amount of support it's giving? Certainly a possibility. They've said they could be there. And the third one is always going to be there, is liftoff. When are they going to raise rates? Expectations had been maybe December next year. The Fed is telling you in 2023. But the speed at which things are moving could actually bring it back into the middle of the year to actually see liftoff over in the US. Markets are asking that question too. Have a look at the bond market. Having a look at the belly of the curve, it's underperforming what's going on at the front end and the back end. 2-year up very, very strongly and continuing to go. 10-year and 30-year also showing you that there's some real pressure there. And where rates are going to be over the next couple of years is pretty much anyone's guess in terms of how hard it could be. But it does mean one thing from our perspective as FX movers and FX momentum traders, and that is all roads continue to lead to the US dollar. Have a look at what's gone on euro dollar. Best level it's been since midway through last year. Have a look at cable, best since December last year. But the one that we've been speaking about that is basically playing out textbook, follow the yields in the US. Dollar yen hit 114.69. That's the highest level it's been since March 2017. It's eased off ever so slightly, but that momentum behind it is incredibly strong. And there's one thing that we know is going to happen from all of this discussion. Yields in the US can continue to rise as this debate goes, and therefore that pair particularly is the one that I continue to watch, that has been an incredible mover and one I've been really, really positive on for the last few months. You can't say you can change anytime soon, because clearly the momentum is behind it and continue to go with the fundamental, that is real yields in the States.